All right, the July jobs report released today indicates that the U.S. Economy, well, it only added 114,000 jobs last month, and that is significantly down from previous projections and has led to the highest unemployment rate since October of 2021. So what does all this mean? What do these numbers tell us about the state of the economy? And what does it tell us as we head into this coming fall? Well, joining me now to discuss this is Jerry Bowyer, the president of the Bowyer Research. Jerry, welcome to Washington Watch. Appreciate you coming on.
Always appreciate being on. Thank you.
Okay, so we have a weaker jobs report than many expected. Tell us your thoughts and your reactions to that.
Well, it's weaker than many expected because I think that some of the forecasters in the press have been systemically underestimating the weakness of this economy. There's a real hollowness to the American economy that the bull market has kind of kept us from seeing. When the stock market goes up, people think, oh, that's a sign the economy is strong. But not necessarily. The stock market could be going up because there's an expectation that the Fed's going to come and pump money into the system, pushing up speculative assets. GDP, gross domestic product, hasn't gone negative, so it hasn't been officially a recession. But if you look at gross output, which looks at the whole economy, GDP is only a third of the economy. What you see is that actually we've been in a business recession for about 3/4 already. So I think it's only surprising to people who don't realize the economy is as weak as it is. And I think that might have been to some degree market participants, although it's not clear to me whether markets today are responding to the economy or whether they're responding to the election. Because last night, overnight, I don't know if you follow the political futures markets, where people essentially can, buy a future on who's going to win. Last night, the probability market switched to Harris winning. And then what do we have today? A broad sell-off of markets, even when expectations of an easing Fed have increased. So I wonder to what degree we're looking at a Harris trade today.
Oh, wow. That's very, very interesting. And I do think, though, your assessment that the weak report today is really just a mere reflection of the weak economy that we actually have. But in the mix of all of that, it seems like the healthcare industry is continuing to show some growth, as is construction. It seems to be pretty resilient right now. What do we learn from that? Is there anything that we can get from looking at these two areas that appear to be doing fairly well?
Well, I mean, construction had some problems and now it's bouncing back a little bit. Healthcare almost never goes down, right? This is a recession-resistant, it's a non-cyclical, sector, as people like to say. You might not buy a new house, but if you need a double bypass, you're going to get the double bypass, right? You're going to buy your medications even if you don't go out to a restaurant. So people generally don't skimp on healthcare, even if you are entering into a low-growth economy or even a recession. So the strength of the healthcare doesn't indicate that it's a strong economy. In fact, the strength of the healthcare sector and trading relative to other sectors is often an indication of a belief the economy is slowing. Think of it this way. Healthcare is a recession hedge. Consumer staples, as opposed to cyclicals, is a recession hedge. If recession hedges are doing better than the rest of the stock market, that means that investors sense that a recession or something like a recession, what they call a growth recession, which is near zero. A recession doesn't have to be that severe. All you have to do is be negative for 2 quarters in growth and you've got a recession. We have something really, in many ways, worse. We have stagnation over a long period of time. And markets might be looking forward and saying that with a Harris presidency, even the Fed can't bail us out. Even the Fed can't rescue the stock market by pumping money into the system. Because look, today's sell-off was broad. Wasn't just the high-flying tech stocks or even the S&P 500. The Russell 2000, which is a very broad index, also sold off. Everything sold off except gold and cryptocurrencies, which are hedges against some kind of future inflation. So the inflation hedges did all right today, but anything that depends on a healthy economy did quite poorly.
Well, that's really insightful and makes, frankly, all the sense in the world talking about the healthcare industry itself. And I guess the more people get sick, the stronger that is, and people are pretty sick over the economy, among other things, right now. So that in itself, but what you said there makes all the sense in the world. What about the construction side of things? Explain how that, in the midst of a stagnant economy, seems to be doing good.
Well, I mean, that's 1 month report on the construction side. Construction was actually doing badly for a while because when you raise interest rates a lot, what happens is people don't want to sell a house and buy a new house because they're going to trade in to a really high mortgage rate. So when you have really high interest rates, which the Fed was trying to do to fight inflation, people kind of get locked into their houses and they don't buy houses. And if people aren't buying houses, then we're not building houses. But eventually you need to build some. So I don't think that we've seen a sustained period of good construction job growth. I think we've seen a little bit of a blip. And partly that might be as interest rates are starting to come down a little bit. Maybe that'll unfreeze the housing market. So I would not overinterpret the construction jobs. I would focus on when recession hedges are doing well. That's not good news. So I think that's something that we really need to focus on. And just like when people buy municipal bonds, which is a hedge against tax hikes, that's also a sign that people don't expect the future to be good. So I've been thinking about this because I've looked a lot at this data. What's really amazing is every indicator of whether the Fed is going to be easy increased a lot in the past day. Everything that points towards the Fed pumping money into the system and rescuing the economy and the stock market went up, and yet the stock market still crashed. That suggests to me that investors are looking out into the future. They're looking at the Harris trade. And if we get President Harris, I think we can expect a lot more trades like this, a lot more days like this, maybe even years.
You mentioned the interest rate and how all that, of course, ties into the economy. But the Fed's held the interest rate steady at 5.3% this past week. Do you expect them to drop those rates going forward?
Well, I do, but more importantly, the market does, because there's something called a Fed funds futures market. I know that's kind of technical, but it's just a place where investors can basically invest out based on what they think the interest rate's going to be in the meeting in September, and then after that, in this case, before yesterday, they were expecting a quarter percent cut. Now they are overwhelmingly expecting a 0.5% cut in September, and then just a couple of months right after that, they're expecting another 0.25%. So markets are convinced that we're going to get almost a whole percent cut just in the next two meetings. So markets are confident, and that's why gold went up. Gold goes up when we expect the Fed to be debasing the currency. And I think I'm not going to try to be smarter than the markets. If that's what they think, that's what I think is going to happen, which again raises the question. That's supposed to make things easy. That's like Prozac in the water supply. That's like, taking your kids out for sprinkles and sugar. Where's the sugar high from the easy money Fed? Well, we don't get it because we have a Harris presidency hanging over us, suppressing the market, saying we don't even think the Fed can rescue us.
Yeah, that's very interesting how you talk about the Harris market and all that. So, I mean, to be honest, kind of when I looked at the market sell-off, if you will, today, I assume that was because of the jobs report. And I would think that would be somewhat a normal course of action. But you're saying it's much deeper than that, the sell-off today, correct?
Yeah, yes. And actually, the pattern has been when you have a weak jobs report, the market goes up because the central bank, the Fed, it's an $8 trillion hedge fund now. The largest investor in our economy now is not any private actor, largest investor in our markets, it's the Fed itself. So what's been happening for several years now is when there's bad news in the economy, there's good news in markets. Why? Because when there's bad news in the economy, people say, oh, well, the Fed's they don't want a recession, so they're going to pump money into the system. So I saw a lot of headlines today saying, well, the market's down because of bad economic news, to which I said, for years, we haven't seen the market down on bad economic news. We've seen the market up on bad economic news because Fed to the rescue. The market being down on bad economic news breaks the pattern. And it's breaking it strongly. So that means I think we need to look for another explanation. And the fact that Harris has been surging, The media is just has a love affair with her, and they're just love bombing her. A lot of propaganda. They're going after J.D. Vance a lot, and the probability
Very
market
interesting.
overnight shifted towards Harris. Guess what? Next day we have a market correction. I think there might be something
Thank you,
going
Jerry
on there.
Bowyer. Thank you so much, President of Bowyer Research. Great information. We appreciate it.